morning, everyone, and welcome to the Jacobs Levy Equity Management Center for Quantitative Financial Research Spring Forum for the year 2016. I'm Chris Gatesy, Academic Director for the Jacobs Levy Center, and it's my pleasure to host today's event.
When Ken and I started our firm 30 years ago, terms such as alpha and beta, as applied to investing, were rather esoteric and mostly confined to an emerging discipline known as quantitative finance. Today, you don't have to be a quant to know the difference between alpha and beta, or to have an opinion about whether one or the other is smart or dumb, active or passive, or something in between.
There's a great deal of volatility in this market. And if you love volatility and if you love high Sharpe ratios and high information ratios, China is an exciting market.
A contrast effect is a very old finding from psychology, and the basic idea is the value of something that you just recently saw inversely impacts how you currently see something. We're going to ask, do these contrast effects matter for prices in financial markets? And we think this is a nice contribution because relative to kind of the laboratory settings or this little bit of field evidence, we're going to be looking at prices set by full-time professionals who are making repeated decisions with high stakes. And of course, we're looking at prices. This is an equilibrium outcome. So even if there are just a few investors who say exhibit contrast effects, maybe they aren't relevant for setting prices.
As a Wharton grad, it means a lot to be invited to come present at this conference. We're going to say, okay, what explains the performance of this sector? And the method we're going to use to get at that comes from Bill Sharpe's 1992 model. The style model. And we're going to use that to dig into what explains the performance of the institutional side of the asset management industry.
One of the challenges that we've had, not just in the last year but over a longer horizon, is exactly what defines smart beta.
These are strategies designed to outperform broad cap-weighted indices. So, by my definition, that's active.
We manage a lot of passive investing, so we think people who invest passively are also very smart.
I think there remains a strong place for the passive index because, unfortunately, when we look at what investors actually do instead of what prescriptively we suggest they should do, is they have a performance-chasing style of selecting active managers.
We all know the foundational role Bill Sharpe has played in the development of quantitative finance and the growth of risk management as a sophisticated professional discipline. And his contributions to economics as a whole.
Bill has said that he likes to pursue, quote, useful theory, and his activity bears that out. Well, we like useful theory too. In fact, it's the very essence of the Wharton-Jacobs Levy Prize, which recognizes not just outstanding theory, but theory that leads to important innovations in the practice of finance.
In awarding the Wharton-Jacobs Levy Prize to Bill, we recognize his work on returns-based style analysis. Using a factor model and historical return patterns, Bill showed how to map a fund's exposures to a wide variety of investing styles. Bill, we are proud to present the Wharton-Jacobs Levy Prize to you. Thank you for your many contributions and a hearty congratulations. Bill, please join us at this time.
I'm going to put it on.
Oh, sure. Be my guest.
The idea was we were going to develop techniques that would be helpful to the manager of the fund. Here was, what you could do for each of the managers. You could do the style analysis, you could do the performance analysis, you could aggregate into domestic equity managers, you could aggregate to the whole fund.